Good morning and welcome to Unusual Activity powered by FinancialJuice.com with George Avedon and Milton Romanides. Good morning this Monday, February 2nd, 2015. Certainly lots happening geopolitically, macroeconomically, commodities, currencies, always never short of information and news coming through the markets, and of course unusual activity. We are pleased to have this morning Yohay Elam from Forex Scrunch will be joining us in about 15 minutes. So let's get into the numbers. What we are seeing this morning, we have S&P futures higher by 2.25 points at 1990.75. The dollar lower this morning at 94.766, lower by 0.034. The euro higher this morning, 0.0018, still in that 113 handle, the 1.1314 area. We saw that last Thursday, Friday, last week, getting into this particular area. We'll see what happens the rest of this week. Gold continuing its decline, lower by $7 now at $1,272 even. Crude oil higher by 67 cents at $68.90. We saw a pop in crude oil towards the end of the day, towards the close of floor trading in West Texas Intermediate crude on Friday, still above the $48, currently $48.91. We have the 10-year at 1.691, maintaining that below 2%. We have the 30-year at 2.271, and that's what we feel is the larger story. And that's rather important there. So let's jump into some of the material from Friday. We have the Dow Jones Industrial Average lower by 1.45%. That's 17,164.95. S&P 500 lower by 1.30%. at 1994.99. We discussed that 2000 level as being rather important when we're looking at specifically the technicals. The NASDAQ lower by 1%, 4635.24. If you take a look at the activity on Friday, rather volatile in market, continuing that volatility. We saw really most of the day really in negative territory in the SPX, and really a little bit of a try for the positive right around the 230 mark, right when oil was closing, but really a deterioration in the last hour and a half towards the low of the day on Friday. Remember, it's typical Fridays, and again, so keeping an eye on these indices this morning. Certainly from a geopolitical perspective, we have certain areas that are on the radar once again, keeping an eye on the Middle East with respect to ISIL, certainly. In addition to that, in the Middle East, Saudi Arabia's rhetoric, conversations with respect to oil. There's a lot of conversations, whether or not Saudi Arabia will be changing its stance or will be continuing. A lot of analysts, a lot of pundits out there having an opinion on that. As we hear things, we'll certainly report that to you. Another area that we're keeping an eye on rather closely is the Greek debt deal. We talked about some weeks for weeks now with respect to this notion of the Grexit, the Greek exit from the euro. At least for the time being, we don't see that happening. At the same time, lots of conversations, lots of geopolitical conversations there, In addition to that, the Russian-Ukraine situation, violence is increasing there, and that's something that we're going to continue to watch. Again, with respect to Russia-Ukraine, want to see what kind of reactions there are in the market with respect to specific events that occur out of the Russian-Ukraine situation. Themes of the day: we're watching this euro, watching the U.S. dollar. Typically, we're seeing a strength in the U.S. dollar, weakness in the euro. Certainly, we're looking forward to the conversation with Yohay, get his opinion on things. But again, themes for the rest of 2015, and as we've been saying for most of January, it's this notion of a weaker euro, strong U.S. dollar. Also, oil certainly has been on a bit of an uptick. Can oil catch a bid, at least in the short term? One of the things that we've been discussing, and also last week with Dave Landry and Larry Gaines, is this notion that it's not the fact whether or not oil can go down any lower. It's the fact that it's already low enough that it's having an impact. And the lower it stays below 50, we're in that 50 range, it's going to continue to have an impact on specific countries, having an impact on individual companies, oil names, so forth. Also in oil, talk of an oil strike certainly perhaps was the catalyst for the oil spike. So again, that's something that we are continuing to monitor rather closely. On the rate side, we've been discussing this. Continuing themes here, folks. The 5-year, 10-year, 30-year in the U.S. Treasuries. Clearly, we have an existing bid in the Treasuries. 10-year currently 1.698, and of course, we are in earnings season, and we'll get into those numbers in a bit. From a manufacturing perspective, from a macroeconomic perspective here in the U.S., Baltic Dry Index continues to fall another day, 3% lower at 590 points. Folks, this is a great, and we say this every day, and we're amazed at how many folks don't follow this index, but it's a great index to follow with respect to possible economic activity. It's a leading indicator, we feel, and it's basically a way to see the activity, shipping activity for dry goods, grains, raw material with respect to shipping. So great indicator to watch, and that's been on the decline for a considerable amount of time, and multi-year lows there. Also, we had PCE deflator. We had it lower by 0.2%. Expected was 0.3%. We have personal income lower by, personal income, month over month higher by 0.3%. Expected was 0.2%. Previous was 0.4%. So again, the PCE deflator is something that we know central bankers watch rather closely. Remember, inflation target is 2% globally for inflation. And that's something that we are continuing to monitor rather closely. This morning also at 9:45, we're getting the Purchasers Managers Index Manufacturing Index. 10 o'clock ISM Institute of Supply Management Manufacturing Index. 10 o'clock construction spending. So certainly lots more news to come. Let's dive into a little bit on Russia, something that we always talk about. and discuss. We want to keep an open perspective on at least what's happening, the news that's coming out of specifically Ukraine. Remember, there's the Western perspective, and then there's the Russian perspective, and this is something that, could there be internal strife within Russia? And really, it's not the fact that whether or not Russia will have experienced more sanctions with activities in Ukraine, but really, what's Russia's reaction to that? And specifically, we say this before, and we'll say it again, Putin has an all-time high approval rating in Russia, and that's something that we want to keep an eye on rather closely there. Something that we this fifth bullet point here that we're keeping an eye on is the Russian-China relationship. We mentioned this some time ago. Remember, the more sanctions there are from the West, the more Russia will go to other countries for relations, i.e. China, Venezuela, Iran, various other countries globally. So that's something we want to watch rather closely. Let's take a look at where we are overseas. Nikkei in Asia, Nikkei lower by 0.66%, Hang Seng lower by 0.9%, and the Shanghai lower by 2.56%. Now, we can take a look in Europe. We have the FTSE higher by 0.07%, the CAC in Paris lower by 0.05%, DAX in Germany higher by 0.45%, and the IBEX in Spain lower by 1.74%. Now, one of the things that we always would like to bring up when we're talking about oil names is a list of ETNs, ETFs that we like to watch rather closely. You can take a look at OIH. These are underlying certainly oil names, larger names there, Schlumberger and Halliburton. Really want to see where the volatility in oil, specifically West Texas Intermediate crude, and how it relates to the underlying securities. And remember, folks, this is something that we like to bring up, and that is the longer oil stays lower priced, whether it's in the 40s or lower 50s, it's going to impact CPI, it's going to impact PPI data as well. Remember, it's certainly can impact how central bankers view potential inflation and how they configure, how they consider oil within that equation. We like to put this up as just a difference of opinion here. Some time ago, Secretary Lee basically says doesn't expect U.S. crude production to decline. Goldman Sachs' Cohen indicating oil prices may hit 30. So as long as we see a difference of opinion, whether or not there are certain analysts or pundits or institutions seeing a lower oil, or at the same time we're seeing specific traders saying, hey, what a great opportunity for to start nibbling on oil, that difference of opinion we feel contributes to the volatility in oil. We can take a look at where we are in commodities, energy, and raw material. We have crude oil higher now by $1.39 at $49.63. We have gasoline at 1.5369, higher by 0.0579. Natural gas lower by 0.04 at 2.650. Heating oil higher by 0.0491. Just as an anecdotal, here in the Northeast, we are just getting walloped with snow and cold weather, so that typically has an effect on specifically natural gas and heating oil. We can take a look at gold this morning. We have gold at $1,268.90, now lower by $10.40. We have platinum at $1,225.60. Silver at $17.08.50. Quite a bit. That's a dollar move here, folks, in silver within a few days. That's rather impressive. And cocoa lower by $14 at $26.79. So let's take another look at yield. We have the 5-year at 1.210, the 10-year at 1.700, and the 30-year, folks, at 2.280. So clearly, our opinion, this is, although not widely discussed among other news organizations, but really the bigger story here is what's happening to this yield curve, and let's call it the convexity of the yield curve, and where do we go from here. So, folks, we are once again very glad to have Yohay Elam from Forex Crunch, Twitter handle at Forex Crunch, and you can find Forex Crunch on Financial Juice in the news settings in the educator section. Yohay, welcome on this first trading day of February.
Hi there, can you hear me?
Hey, how are you, Yohay?
I'm good, thanks.
Good to have you back. Yohay, please take a moment or two for yourself to introduce yourself, what you do, how long you've been doing it, and then we'll get into the nitty-gritty of the markets this morning.
Well, I've been running Forex Crunch since 2008. Beforehand, I used to be a retail trader and a computer programmer. I began the site as a blog, and I had lots to say, so now I do it full-time. The site focuses more on fundamental analysis and just a bit touches on technical analysis. I like to discuss the big things that move the markets, the macroeconomics, the fundamentals, and I'm happy that we've got volatility back.
Yeah, we are you know, you and I were speaking back in December on how it was I think we coined it a ho-hum market. What a difference a month makes, or call it maybe about 40, maybe 35 trading days or so. What a difference a month and a half makes, huh?
Yeah, it's been quite a ride. Well, the ECB has a lot to do with it because the Swiss National Bank's move was, of course, related to the ECB, and everything is related to the price of oil. Correct. So maybe it all originates from the fall in the price of oil, I think.
Sure, no, absolutely. So, you know, I have let's jump into a couple of things. You know, while we were last several weeks, we saw this really amazing move by the Swiss National Bank, where they removed their cap and really roiled the markets. It certainly threw accounts into a bit of a tailspin. Is this, you know, can we anticipate more of these type of moves from other central bankers? Let's go really high level here first. Is this normal? Is this something that's, can we anticipate a little bit more of this?
I don't know if we can anticipate an event of such a magnitude, but black swans are a little bit more common than we think.
That's right.
So we can expect the unexpected. I think if we take one step back from this decision, it was bound to happen one day, and we couldn't expect the SNB to communicate that it would remove the peg. Otherwise, it would have attracted more speculation. Yeah. So, I mean, you have to. My advice all the way to traders was, look, this currency is being manipulated officially. Just stay away. I mean, you don't know what's going to happen. I don't think such a big event might happen, but can have surprises. We had, for instance, a rate cut from the Bank of Canada after nearly 5 years of them not moving the rates at all. And maybe later on tonight, the bank in Australia, central bank in Australia, the RBA, will cut the rates. Now markets expect more move than a few weeks ago. Right. But I think we can expect more volatility after, I think, some relatively quiet 2 years or so.
Yeah.
So I believe action, maybe not this extreme, but volatility is here to stay.
So is your opinion, and certainly you've been in the markets for such a long time, and it's great to have you on. Is your thought process that we have this?
Can't hear.
Yohay?
Yes.
Sorry, I think we had some technical difficulty here just for a moment. Is your opinion that larger institutions, larger desks have now reconfigured their risk model in a way to, as you say, black swans are not that uncommon, right? I mean, they can come in different forms. They can come in, they can manifest themselves in different situations. Is this one of the things that you're thinking about, that perhaps the larger banks, larger traders out there have had to reconfigure their risk models a bit?
Yeah, I think they did reconfigure them a bit. We also have some geopolitical stuff you mentioned before on the show. Yes. Ukraine and Russia, and the headline I saw crossing is that Obama considers, for instance, giving arms to Ukraine, and this could be a sort of significant development. I don't know if it'll really materialize. And I think something that our friend Amaro was talking about in the past, some kind of stock market crash. I don't know. There are some good stocks out there, of course. When Apple releases an excellent report, it makes sense that the stock rises in value, but I don't know, we didn't have a really big correction or a downturn in so long, so I hope that markets are reconfiguring themselves and taking such an event into account of a significant fall in stock markets. I don't know if it's going to happen, but as we said before, anything can happen, so
no doubt.
Need to be prepared.
No doubt. Yohay, so much to talk about. So let's let's spend a little time, if you will, on oil, right? I know you watch a huge amount of information, as do we. We look for news, we look for data, anything that's that would potentially move markets, both from the short term and the long term. Let's jump into oil a little bit. So we had this, there's this let's call it this notion of a particular, a speculation of a strike, right? We know that these things can be relatively short-lived, right? So we have to keep a little bit of a caveat there, right? But how do you perceive oil now? Again, I know you look at fundamentals and technicals. What are you seeing out there? What can you tell our listeners that would at least provide some color to the oil trade?
Well, I think perhaps we haven't seen the very bottom yet, but we're very close to finding a bottom. I think we might see one more dip to just below $40, another small shock. But eventually this price of oil is a bit too low for too many countries, including the United States. So we've seen in the latest rig count, I think on Friday, that 90 rigs were shut down. I mean, it was quite a significant drop, and now we have the strikes. So now we have a few things supporting a stronger price of oil. I think the sweet spot for the United States is around $65, $70, something like that.
Right.
I mean, comfortable enough for consumers, but also viable for oil producers in the United States. So I think that perhaps after one more dip, we might see the price of oil quietly move up back to around these kind of prices, and that would be sort of the sweet spot. Also, would put Russia less in a corner, would make it easier also for other countries like Nigeria, Venezuela, and also Arab countries. I think that, well, you hear from Saudi Arabia and the United Arab Emirates and Kuwait that they can live with low oil prices. I think they don't want such low oil prices for too long. So I think it's about to bottom out. Bottom out. It might be a quiet bottoming out without any fanfare like the big crash we had in November, December. But I believe prices will eventually tick up one step at a time.
Sure. Let me ask you this. Let's complicate things just for a moment, right? So let's assume that oil, as you say, and we definitely see that potential certainly increasing. Bottoming out a little bit. We've heard from several guests of the show that that 39.40 level, 42 level should it go through again that 44.20 test, possible bottom. So let's say we do see, let's say oil starts to meander upwards a little bit. What's the impact on CPI, PPI? We know that the central bankers are watching this rather closely, whether or not they admit to it or not. They're watching it rather closely, and oil's implication on CPI, PPI data. What will happen possibly to central banker action as we get into 2015 if we see oil start to rise a little bit?
I think if it rises a little bit, it'll be positive. Also, it'll be a sign of relief for the European Central Bank, because their mandate is headline inflation. So it'll be a good thing for them to get some support from rising oil prices after oil prices sent the Eurozone, including Germany, into deflation. In the United States, I think it'll help oil producers stabilize, less jobs cut. But in the United States, there are, two key differences from Europe. First, the fall in oil prices had an immediate impact on the U.S. consumer because there's hardly any tax in the United States, whereas in Europe it takes a longer time to have an effect and a smaller effect. And the Federal Reserve is seeing through oil prices. We've heard that from Janet Yellen back in December, and they're targeting core inflation, or even more importantly, the core PCE price index, which we got just now. So of course, there's always a danger that oil prices will follow through into core inflation as well. But if we get some stabilization, a small rise in oil prices, in any case, headline inflation will rise just a bit to more normal levels. And I think that if the United States gets headline CPI of about 1% and core inflation of about 2%, it'll be sort of the perfect scenario for the US dollar. If the Fed can raise rates and the US consumer can continue buying. So if we do get to the sweet spot that I'm imagining, I think it'll be the perfect scenario for the US dollar.
Absolutely. And one other question on oil, Yohay, and this is, we hear so much rhetoric, so many opinions on where oil should be. How much merit do you give, whether it's a comment from a Saudi prince, or maybe it's a comment from an oil mogul? How much merit do you give when somebody says, oil will never see 100 again, or you see someone else saying, indicating that, hey, we could see oil, from Goldman Sachs saying we can see oil at $30. What kind of, how does that go into your let's call it an algorithm, your formula of determining where oil should be?
Well, it does have an impact, because in the words of a Saudi prince, he's connected to the oil production. It's a major oil producer. They have an impact on the market, and Goldman Sachs, also known as the vampire squid, they also have an impact. So everything these kind of people say has an impact on markets.
Yeah.
We'll never reach 100 again. I say never, and if we have low oil prices for a long time, that means we have less oil production in the United States and also in other countries. So eventually, and on the other hand, we have more demand because oil is so cheap, so why not get more of it? So eventually, it's a self-correcting sort of pendulum of prices. So if we get, we had high oil prices for too long, and then we had a crash. If we have low oil prices for too long, we'll have it shooting up, and the 100 is quite realistic.
Right.
We have a gradual correction on some kind of middle ground and some fluctuations over there, then maybe we'll not see $100 for a very long time. But eventually, too low oil prices will make the price shoot up eventually.
No, absolutely. Would like to get into a little bit on the yield curve. I know you watched this rather closely. One thing before we actually get into the actual yields and your opinion on so much, and that is, we heard several weeks ago an analyst talking about this, and actually, and there we have the markets open in New York at 9:30 here, folks. We'll have Yohay back in just a moment. So what we can do is take a look at some what's moved up. There you go, Yohay.
Yes.
Yeah, there we go. So let's tap into a little bit. One of the things that what we find fascinating, a lot of folks have been talking about the S&P 500. The fact, could it come in for a real correction? We're, right at that. Let's see where we are currently on the S&P 500 futures. Currently at 1995.75, up now 8 handles, 8.25 handles. Certainly a nice tick up. Again, really being attracted to that 2,000 level. One of the things that we notice is if you take a look at the yield of the S&P 500, and currently, let's say it's in that 1.87 level, the 10-year at 1.701. This happened a few years ago, and I, again, agree, disagree, but as long as that 10-year is below that S&P 500 yield, you'll have a considerable you'll have a considerable bid in the S&P 500. It happened a few years ago. We're seeing that now. Thoughts on that before we get into the yield, before we get into the treasuries? Any thoughts on that?
Yeah, it makes sense, and you get a better return if you
better return.
Yeah, so that's where you put your money, and not where you get a lower return. I think a change might be seen. I think the markets are not believing the Fed. Don't think that the Fed will really raise rates in 2015 because inflation is too low, because there's a global slowdown in China and Europe, because of many other reasons. I still believe that the Fed is set to raise rates, maybe if not in June, then in September, and the markets will believe it only when they see it. In this case, with all the preparations, communications, Fed speeches, changes in statement, meeting minutes, I don't think, even if the Fed makes this symbolic move, just instead of 0 to 0.25% interest rate to a set 0.25%, just that symbolic thing, I think that's what will trigger perhaps some kind of small shock or maybe a bigger one in stock markets, and perhaps a move in bond yields. That's when people will begin believing that rates are going up, maybe not to historic levels, maybe slower, but that low interest rates are not here forever because, well, they've been here for, forever, since 6-7 years. So
it's been a tremendous long time. Look, I mean, I think you and I have spent, and Milton has spent a tremendous amount of time in the industry. We've been around since the mid-90s. The reality is that we feel that the Fed needs to react, always reacts to the market, right? The Fed does not want to create waves. unless there's something cataclysmic. It's always there for the support of the market. Our feeling is, and again, very simply stated, but really one of the first things I learned in Econ 101, I'm dating myself back in early 90s, and that is when Greenspan was around, and that is just the intention of the Fed doing something, the market reacts to that, and that's still the case today. And whether it's commentary and so on, but again, certainly points to an interesting environment. If we could, what's your taking a look at this? I mean, look at the 30-year at 2.277%. Looking at the yield curve, 10-year, this is in the U.S., folks. 10-year, 1.695. The 5-year had a massive move of about 46 basis points from about a month ago or so. What's your take on that? Give us your how do you what's your take on the yield curve going into this?
Well, that the market doesn't believe that the Fed is going to raise rates, and also I've read some interesting opinions that this implies a recession also in the United States. That means the United States just cannot decouple from the rest of the world. If Chinese growth is falling below 7% for this huge number 2 economy in the world, and Europe is also wobbling around, and Japan doesn't get out of its deflation trap, and the U.S. Bond yields imply a recession. I'm much more optimistic. I think the U.S. economy is still doing well, and that it can move forward, and that the Fed will eventually raise rates because employment is going up, and eventually wages will go up as well, and so will inflation. So I'm still optimistic. I think that markets just are too pessimistic at the moment, and this is what's reflected in the yield curve. In addition, there's just a lot of money still going around. It's important to remember the Fed ended its QE program, but it still reinvests the proceeds. That means the balance sheet is still $4.5 trillion.
Right.
The ECB is now beginning to enlarge the balance sheet. I mean, you mentioned the yield curve in the United States. I'm sitting here in Spain, 23.6% unemployment rate, and 10-year yield is lower than in the United States. So I think there's just too much money going around and seeking these safe havens and half safe havens like Spanish bonds. So
no doubt. This is something that we follow rather closely, and as you said, it's if you're taking a look at the yield curve compared to a little bit more than a year ago, it's quite, I don't want to call it flat. It's not a flat yield curve. There's still a little bit of a pitch to it, but certainly it would be the right to say so we're currently not in that massive expansionary environment. Certainly, the contention is that the U.S. has a capability of decoupling from the Eurozone and some other China slowdown and so forth. But that's something that's rather interesting. While in the EU, Yohay, let's jump into a little bit on the Greek festivities, if you will. What's your thought on this? So certainly there's been a lot of rhetoric, a lot of conversation that they were going to leave the euro, threatening to leave the euro. It's a lot of conversation. Certainly they haven't left the euro. What's your go from a geopolitical perspective first? What's your thought on that, and what does Greece need to do to first to kind of stabilize themselves a bit?
Well, I think they took one measure, or announced a potential measure today or yesterday about giving some exemptions from money made abroad or something like that, in order to get money flowing back into Greek banks, because there have been significant outflows in December and January. So that's sort of an immediate step. I think eventually there's a difference between what politicians say before the elections and what they do afterwards. It's right basically everywhere. So I think eventually Alexis Tsipras will find a way to come down just a bit, and so will the Eurozone. I think there is room for concessions also there. We heard Jean-Claude Juncker, the head of the European Commission, saying that they're ready to abolish the Troika, something that Greece demanded. So I think eventually they won't call it the Troika, and they won't call it the third bailout, or they'll find some kind of compromise. I see two reasons for the Eurozone to keep Greece in line. First of all, if Greece leaves, that means anybody can leave, and
Correct.
Germany doesn't want that. Germany needs the Eurozone in order to have a weaker euro, in order to support its exports. That's not the only reason, but that's sort of a significant economic incentive. Another reason, as you said, I think, or hinted about maybe, is geopolitical.
Yes.
Greece is in the eastern flank of the Eurozone, close to Russia. We heard some sort of pro-Russian comments, if you want, from the new Greek government. I don't think Angela Merkel or Obama or anybody in the West likes that. So if Greece falls out of the Eurozone by accident or by intention, they could fall into Russian arms, and it's not a scenario that Germany, France, the United States, Britain want. So I believe there's a difference between what also Germany and Greece and Tsipras said before the elections and what will happen now. They'll find some kind of concession, some kind of compromise. It's very common in the Eurozone to find some last-minute patchwork compromises. So I think currently, of course, it's for me as a website publisher, I have a lot of news to write about regarding Greece, and it still moves the euro. But eventually, I think that the outcome will be a bit more. We won't have a lot of volatility in markets from Greece. The ECB QE is much more significant. The moves of the Fed are more significant. What's going on in Ukraine is more significant, I think. So, well, I'm optimistic today, and optimistic that Greece will find a way with the Eurozone. They'll find a way, one with each other, to get to some compromises on austerity and the moves forward for the Greek economy.
Yeah, no, absolutely, and we tend to be in that same in that camp, if you will. One of the things to always consider is, remember, there, you know, the reason, and this is something we're under the impression that it will be very difficult for Greece to leave the euro. Not impossible, as you always say. You know, it's never say never, but really, why did the European Union was created from a historic perspective? It was for unity. It was for a one continent, many nation type environment. The individual was actually whose idea behind the EU actually won the Nobel Prize for that, and that's something to always keep in mind as conversation come in to someone leaving the euro, specifically the currency, not the eurozone, but the euro, but to really keep that in mind. And yes, Yohay, we totally agree with you. It's the reason that the ECB is quantitative easing. They want to keep the euro low to really exasperate, if you will, the export side of the business. Export side of the equations in the eurozone. While on in Europe, thoughts on ECB? You know, conversation. You know, we haven't spoken in a while. We have so much to catch up on. But you know, what's your thought on? You know, could we see? I mean, the conversation is going into 2016, right? For quantitative easing on the part of the ECB.
Yeah, when Draghi was asked in the press conference what's the next move of the ECB after QE, if it'll be a tightening move, he began laughing and said that he could pull out some jokes, but he doesn't want to. So I think the ECB is not is not going to end QE in 2016. It's going to push forward and print more and more euros. It's good to move money into the real economy, and to move money out of the eurozone. That means a weaker euro. I think eventually it'll be supportive more through the channel of a weaker euro than from money reaching the real economy. I mean, my anecdotal evidence here in Spain is that banks are more willing to lend. So the ECB's moves are making it easier to borrow money, but the problem of demand is still here.
Yes.
Spain is not alone. I mean, the unemployment rate in the eurozone is 11.4%.
Yes.
Eventually, with the weaker euro, with stronger exports, with the money, I hope, flowing also into investments through the European Commission, the Juncker plan, which, well, so far all these plans from the eurozone have been quite futile, but maybe this time it'll work with the help of weaker euro. I think we have some room for recovery, but it doesn't mean that QE will go away in September 2016. It could continue until we see really inflation expectations, as Draghi said, go beyond 2%, until there's really some kind of danger of inflation, which now seems so far away.
Yeah, no doubt. You know, Yohay, I think you hit on some really key points here, and this is something that we talk about constantly. Is you know, some time back we had some traders on, and really, you know, we believe both in the U.S. and specifically the ECB, it really feels like they want to be behind the curve a little bit. Their intention is to be behind the curve. They want to see that, specifically in the U.S., they want to see that labor cost rise as a catalyst for inflation, and proof that inflation is in the works. They want that 2%. They almost want to be behind the curve a bit, and it seems as though ECB, as you said, is not far away from that thought process as well. Now, I have to ask about the euro, Yohay. You know, Societe Generale indicated that we could see 110 on the euro, possibly parity. You know, they said yes, we could see parity, but let's get to 110. Could we see parity in the euro?
Maybe it's hard to say where it'll stop. The same with oil. Currently, I don't think we have bottomed out just quite. We did see a stabilization after the ECB's QE. I mean, a few days afterwards, after the Greek elections as well. We're now just above 113, and we're. But I think there's another dip to come. What I still foresee is that somewhere in the middle of the year, we'll have a turnaround in the euro, and we'll have some kind of. We'll see the money already flowing into the economy. We'll have an improvement, and we'll see the pair rise. But maybe it'll fall until 105. But it's hard to say the exact levels, of course. I think there's one more leg down until the middle of the year. Especially, it depends now a little bit more on the United States about the timing of the Fed decision, and after the dust will settle, I believe that a month after the Fed hikes, we'll have maybe the lowest value of euro dollar, and from there it'll begin climbing back up because of an improvement in the European economy.
Yes.
So as I see it, we'll have sort of a V-shaped graph for euro dollar. I mean, falling in the first half and rising in the second half.
Interesting.
But
interesting.
I said everything is data dependent, and to make predictions for
no doubt.
Is,
no doubt.
Yeah.
No doubt. I mean, look, the reality is things, as we've seen with in the beginning of our conversation with when we see actions like the Swiss National Bank, you know, data is at a premium, and how markets respond to that is rather important. So it's cause and effect constantly, and that's what we watch on a daily basis. Yohay, give us some ideas that you're recommending to traders with respect to currency. If you are, if not, that's fine. But anything that you see as perhaps a good trade, or something to at least to keep an eye on, something to keep a close eye on, maybe in a kind of a mock portfolio, if you will. Anything that's anything that you're looking for in the next, let's call it 1 to 2 quarters out.
Yeah, Australian dollar, one of my favorites. I think I'm not the only one. It's becoming a more and more popular trade in recent years. Well, it has been popular in both directions. The pair is a bit more easy to understand in technical terms. I mean, support and resistance lines, also channels. I think it's quite good. And in general, what I see for this year is continued downfall. I see the Reserve Bank of Australia, they want a weaker Aussie. China is slowing down. Unemployment is above 6% there. So far, rates haven't gone down because of the relatively high, elevated, maybe bubbly housing market. But I think eventually they'll take a page from their neighbors in New Zealand. In New Zealand, they introduced some kind of macroprudential tools to limit borrowing for housing, and they did manage. I mean, that was sort of how they stopped it. So I think eventually the RBA will introduce some kind of tools like these, and on the other hand, will be able to cut interest rates. And that's sort of, if I talked about sort of V-shaped euro and don't know where the bottom will be seen with the Australian dollar, I have a bit of a clearer vision that sort of it'll go down throughout the year. Of course, I may be right, I may be wrong, but it seems to me the picture seems clearer regarding the Australian dollar than for euro dollar, for example. Currencies I would stay away from is, well, the Swiss franc. There is talk about a soft floor there.
Right.
I don't know if it's true or not, but I think we have to give the markets some more time to settle down before we can say, okay, the Swiss franc is a more or less floating currency, and let's look at it again. Fundamentals, technicals, inflows, outflows,
Right.
and not only the S&B. Yeah, so these are the two extremes.
Yeah, no, you know, I think you bring up something, a really great point, Yohay, and that is, the fact that when you have such a large occurrence, such as the Swiss National Bank, you have larger funds that are still waiting to, perhaps, quote unquote, trade out of their positions if they haven't already. That's the other market dynamic that is involved in some of these larger trades that we always talk about, especially when we had this large decline in oil, when we have these huge moves in the U.S. dollar, euro. You really have significant institutions that really need to reconfigure their portfolios with the new, I hate to call it the new world order, but the new configuration of the world. One other question for you, and that is Japan. There's been, certainly, we know that Japan has been in this, stagflation area for it's not even a lost decade anymore. I think we're going on to millennia. The thing is with Japan, and this is something that a lot of people really aren't discussing, is the fact that it's a huge investor in Asia. It invests in China and the surrounding surrounding nations. Any thoughts on that? I mean, should Japan continue its woes? We could see some interesting ramifications of that. What's your thought on that?
Yeah, well, you can look at it as a currency war with China. Their moves in
Right.
recent years, because we had such a strong yen for quite some time, and well, it's weakened significantly, and the Chinese yuan is more or less pegged to the U.S. dollar. I mean, movements are relatively slow there, especially in comparison to what the yen did. So suddenly, Japan is competing in a much stronger manner with China, and of course, other countries are in the mix as well. Vietnam, Korea, Philippines, Malaysia. So I think in order for Japan to reach its inflation target, it'll probably have to do even more. But you can't really solve a demographic problem with just monetary policy, just investment outside the country. And if Japan wants to experience real meaty, let's call it growth, it needs to well
Yeah.
make more children or accept immigration, and
Yeah.
that's a much bigger change than
No doubt.
printing trillions of yens.
Yeah.
Um,
No doubt.
so
No doubt.
that would be the next step, and I'm not sure this government or the next one is able to open the doors to immigration, because if Japan wants growth and it has an aging population,
Right.
um, that's the sort of the bigger picture. If we talked about the last decade, if it wants
Yeah.
to have a successful next decade or next 2 decades or millennia, that's the solution. But
Yeah. Yeah. No doubt. No doubt. No doubt. Yohay, this has been wonderful. Thank you for joining us again. We hope you come back. Every time you come back, we make sure we write down our questions for you and your thoughts on what's happening globally, fundamentally, from a macroeconomic perspective, technically, a really great way of looking at the world. And we really appreciate you. Folks, Yohay's
very
from
much.
forexcrunch.com, Twitter handle Forex Crunch. You can find him on Financial Juice in the new settings in the educators section. Yohay, thank you so much
Thank you. Thank you. It's been a pleasure.
joining us. And we wish you a great day, folks. Thanks for joining us. This has been Unusual Activity powered by Financial Juice with George Avedon and Milton Marmonides, with Yohay Elam from Forex Crunch. Wishing you folks a great day and good hunting.